All right, why don't we get into this? So thank you for joining. We've got a classic webinar topic that I think started doing back in 2020, but yeah, hopefully new for some people and also a good refresher. We're going to talk about how to value a share today. But first, anything that you hear today is, of course, general advice. I don't know anything about you. I can't offer personal advice. It is always great to get questions and comments. So feel free to send those through. And good afternoon, Martin, who sent through our first chat for the day. But anyway, let's get started. All right, so we're going to talk about three different things today. So we're going to talk about what makes a great company. We're going to talk about a discounted cash flow model, and we'll use an example. And we're going to talk about relative valuation measures. Now, InvoCare, as many people are aware, was acquired, but because I think, and this is an old analyst report, obviously, but I think just the way that it's described is great. So that's why we're using it as an example, but I should come up with a new example. All right. So let's start with what makes a great company. And I think for people, I've used this quote a couple different times, but I do like it because I think it does encapsulate investing. So of course, as investors, we look at all sorts of things, but we also look at, and this will be important when we get into the discounted cash flow model, we of course look at financial statements that are put out by companies, but we have to remember, of course, that all the information we have and we can use to make investing decisions is, of course, based on the past. And the value of any investment and how it performs is based on what happens in the future. So that, of course, can be what the company does, how they perform. It can be all the different influences that are going to impact that performance. So the economy overall, new technology, lots of things. So we just always have to remember that. And that is why, of course, this is probably more of an art than a science, but at the very least incorporates both. But let's start looking at the business. So ideally what we want to buy, of course, as investors is we want to buy great companies at reasonable prices. So we're going to start with the great companies, and we're going to talk about the reasonable price part. So really at the end of the day, if we simplify any company, we're looking at a couple different things. We're looking at, of course, how much they sell. So this is top line. And of course, we call this top line because on a financial statement, it is right on the top. And that is, of course, revenue. So revenue is two different impacts: how much you sell, whether that's a good or service, then, of course, what you charge for it. So quantity and price, both very important. Then, of course, we're interested in the bottom line. So once again, we're moving to the bottom line of an income statement now, and we're looking how much they keep. So there's lots of stuff in between. So for any good or service, of course, it costs money to produce that. That's going to be there. There are corporate expenses that need to be paid. There's marketing to go out and sell it, all sorts of stuff in the middle, but we care how much they keep. And that, of course, is the margin. So there are lots of different margins that people look at. At the end of the day, if we're looking at the net margin, you sell $100 worth of goods or services, you keep 50, that would be fantastic. And that, of course, is what we get as shareholders. We get that because they, of course, can give us some of that profit as dividends, which everyone loves. They can reinvest it back in the business, which we'll get to in a second. They could pay down debt. They could go acquire another company. There's lots of different things that companies can do, of course, with that money. But we are really interested in, of course, how much they get to keep. Then the other thing we need to look at is what is the return that a company earns? And this is very different than the return we get as investors, of course, but what does the company get as a return for investing more money in the business? They could invest more money by going out and hiring more people, saying if we hire more people, we'll grow our revenue and profits. They could invest that money in marketing. They could invest that money by expanding production. There's all sorts of things that they can do with it, but we do really care what return they earn. Because, of course, that money is not free. So they are either borrowing it, they are issuing new shares for it, or there's earning it themselves. But either way, there's lots of different uses for that money. We want to see what is that return that they're getting. And that's why we're going to look at these return on invested capital measures. And we'll get a little more into that in a second. But if we very simplistically look at every company, and there's all sorts of different stuff we can look at, all sorts of different measures, but really if we just think about those three things, because ultimately, if they're growing their revenue, if they are expanding their margin, keeping more of that revenue, and if they're earning high returns on what they invest back in the company, those are all very good things. So that is the hallmark at a high level of what a successful company is. And of course, as I talk about a fair amount, we need to think about how that company interacts with the wider industry and wider economy. So what we need to consider is, what is the economic system that this company is operating in? And if we're in Australia, that is capitalism. And the whole point of capitalism is that it is supposed to spur competition. And competition is important. And competition should benefit us as a society because we will get better stuff. Companies will compete by producing better products and services. And we should get it for cheaper, or at least as cheap as possible, because companies compete on price. So those are very good things for us as consumers. They're not good things for us as investors. Ideally, we would like to invest in a monopoly. So a monopoly, of course, there are no competitors. Company doesn't really have to worry about producing anything better, so they don't have to invest in the business. That's good for us as business owners. And price doesn't really matter because there are no other options. So if ideally we want to invest in a monopoly and we want to be consumers in a capitalist society, we need to think about how that interacts with different companies. So this competition means that, of course, if a company comes out with a new good or service, or a good or service they have is really popular and lots of people are buying it, people are going to try to copy them. They are going to try to introduce competing products and, of course, take market share from that company. We don't want that, right? That's why we love this monopoly. Nobody can take market share if you control 100% of the market. And how do companies compete against this typically? Well, they're going to do two things. Knowing there's competitors, they are going to invest more money in the company to create better products or services, or at least portray them better from marketing. And they are going to lower prices as much as possible because those are ways that companies compete. Now, all of these, of course, are bad things for us. We don't want the companies we own to do any of this. We don't want them to invest in the company. We'd like them just to give the money back to us as dividends. We don't want them to lower prices because typically that means lower margins. So some important points to remember. And margins is one thing, return on what you invest in that company is the other, right? If there was no competition, they could earn very high returns on anything they invested in the company. They still might want to expand production, even if they're not actively trying to make better goods and services. Well, those investments would be good because there is no competition. They could just grow their market share until they get to the point where no one else wants to buy anything. So that's why we're looking at these two measures, margin and then the return of what they've invested in the company. And typically what happens is that a company over the long term will earn a return that matches the cost of capital. Now, why is this? Why would you go out and borrow, in a simplistic example, why would you go out and borrow money at 5% and then invest it in something that earns you 5%? Well, you do that, of course, because you are trying to continue the company. There's a lot of people that are, of course, employed in the company that still want it to grow, and you can still grow doing that. And there's lots of different stakeholders that are involved in the company, but that's not great for us as investors because they're not really earning a return on what they're investing in the company. And of course, those excess returns are what flow to us. So that's why we see over the long term companies move from a startup to when they become more mature. We see that return on investment lower to that cost of capital because they want to keep growing and they want to keep investing and expanding the company. But once again, there aren't really those excess profits that are going to come to us. And I guess I just covered this slide. Now, I talked about monopoly before, not the game, but I talked about a monopoly before and how that's very attractive for investors. That generally does not happen. There are a lot of rules and regulations in place to make sure there are not monopolies, but we still want to look at companies that are able, that there's some attribute around that company that can hold those competitors off. So we're looking for those competitive advantages, and we're looking for those competitive advantages to be sustainable so that they do not follow that arc where all of a sudden they're just raising capital at a certain cost and then investing it and earning the same return. So we're trying to look for that company that avoids that arc, that can keep earning those excess returns, that can have the highest margins, that can earn returns that are a lot higher than than the capital that they're actually investing in the company. And so these sustainable competitive advantages have become known as moats. So we talk about moats a lot at Morningstar. It's obviously part of our analyst rating, but the term moat and the concept of moat is certainly well before Morningstar's time. Warren Buffett talks a lot about it, and a lot of investors talk about it because it is a really important concept, because if you can find those companies, really good things happen to you as an investor over the long term. And of course, it's called a moat because a moat surrounds a castle. It's protecting the castle. We're looking for a moat around that company, and that protects the company from all of those bad things that competition brings. So we'll talk about moat briefly, and we'll go through some examples. And the examples really are just to bring this to life. So, Morningstar has identified 5 different sources of moats. Once again, this is not really a unique Morningstar thing. You will hear this from all sorts of investors. And while maybe they haven't defined them all in 5 set areas, you'll hear these same terms: switching costs, network effect, cost advantage. So you'll hear about these a lot. So this is really a way that most investors look at a company and try to identify those great ones. I'll go through them quickly. Intangible assets. So very briefly, a tangible asset is something you can see and that sits on your balance sheet. So a tangible asset could be a building. It could be a factory. It could be an airplane if you're Qantas. That will be sitting on the balance sheet. We, of course, depreciate those tangible assets. An intangible asset is something you can't see, but that benefits a company. So brand is a perfect one. I think all of us have certain brands that we gravitate to. And because of either what you think about that brand or just the attributes that are associated with it, or perhaps what that brand reflects to others. If you want to buy a fancy car or buy designer clothes, that brand has value. So at the end of the day, if you we'll use clothes as an example, and I'm not very fashionable, if you can't tell from this video, but if you stick a designer brand on a t-shirt, you can sell it for a lot more than just a t-shirt, right? So that brand has value. Patents, of course, have value. So this is a place where the government has jumped in and said, hey, we want competition, but we also want companies to invest in research and development to try to create better products. So we're going to give you an advantage that if you go in and create something new, that will be protected for a certain amount of time in certain ways. Government license is another intangible asset. So none of these brands, patents, government licenses, none of them show up on a balance sheet. But a government license, and the easiest one to kind of think about is gambling, right? For a very long time, New South Wales, for example, only allowed 1 casino. So they said only Star can have a casino. They have a license to that. They have a government license. Nobody else can open a casino. Well, that was very valuable for them because, of course, that held back competition. Things have changed a little bit. Right over there, we're down in Barangaroo, is the Crown Casino. So things have changed. But once again, there's only 2 casinos. Not like anyone can go out there and build a casino. So, of course, those government licenses matter. And the company I just used was Coca-Cola. I mean, they have a very long and well-established brand, whatever you actually think about it, it does, of course, help them from selling cheap water with a bunch of sugar and, some food coloring in it or whatever they put in it. That brand matters to them. Cost advantage. So this one should be obvious. I think is very intuitive to people that if I can make things cheaper than my competitors, and a lot of cost advantage comes from scale. If I can make things cheaper than my competitors, well, that's a really good thing, right? I can go out there and sell stuff for the same price if I want, and I can make more money. My margin will be higher. That if I can create that good or service cheaper, my margin will be higher. That's really positive. Or I can go out there and say, well, I'm just going to undercut my competitors. My price will be cheaper, and that'll help me grow market share. So people gravitate towards that cheaper product or service. So cost advantage, I use Amazon. You hear all these stories in the US about how Amazon has put all of these, brick and mortar retail businesses out of business because they're able to sell things for cheaper. So people don't go shopping, they just order it. So Amazon's the example. Switching costs. And I should note that a company can have multiple sources, right? You can make something cheaper and have a great brand, for example. Switching costs is simple. If it's a pain to switch to another provider, you won't. So that protects your market share. You could do things like charge higher prices because people are not going to switch. And the banks are kind of a classic switching cost. And you read all the time about the big four banks in Australia, and you read all the time about people complaining about them, that they're not passing on interest rate increases either totally or as fast to people with deposits versus people that have taken out loans. All of this stuff, you can get higher rates generally from online banks, but yet they still have a huge amount of the market share. Why? Because people don't like to switch their banks. It's a pain. And so when you sit there and say, okay, well, I can get 0.5% more of interest if I go onto an online bank, a lot of people won't bother doing it because they don't want to go through the trouble. And that, of course, accrues to the banks because over their huge deposit base, may not seem like a lot, 0.5%, which I've just made up, but they provide less interest to people, but it makes their cost of funding cheaper. So switching costs is a moat source. Network effect is pretty simple. The more people that use a product, the more valuable it becomes. Now, that's not all products, but certainly for some products. Social media is kind of the classic one we always talk about. But network effect, there's lots of businesses where the more users that use it, the more valuable it becomes. And social media, the simple one is like, who would want to go on social media if nobody else is on there? It kind of defeats the whole purpose of sharing things. It defeats the purpose of a company going in and advertising on that social media. So there is a network effect. The more people you have on social media, the more valuable that is for users, and the more valuable it is for advertisers, where, of course, you're making money. And efficient scale is probably the one that is least likely, I think, for people to intuitively get. But efficient scale is pretty simple, that if you have a very small niche market, other people may not want to compete there. They may say it's not worth it. So I use Union Pacific. It's a railroad. But yeah, pretty simple. If you go through and you own a railroad, is somebody going to build a railroad right next to yours? Probably not. It's a lot of investment that you need to make. You've already kind of secured that market. People probably aren't going to go invest in that. So you get that when you get these kind of niche markets. We see it a lot with pharmaceuticals as well, that if you come up with a cure that works or a treatment that works for a disease that not a lot of people have, well, the other big drug companies probably aren't going to invest and try to create something better for that because the market's so small. So that's efficient scale. So we did have a question, a good question. So John wrote, does long-term evidence support the moat concept? For example, over the long term, do moat companies as a group outperform the market? Well, that's a good setup. So return on investment and margin, as I said, very important concepts. Companies with higher margins are better. Companies that can invest money, and that's what return on invested capital is. What return are you getting on money you invest in the company? that is a very positive thing. So one thing I would say, of course, is there is no, a moat, of course, is an opinion. It is an opinion of our analysts at Morningstar, is opinion about lots of different other investors. So there isn't any way for us to really sit there and say that this company has been stamped with a moat unless we go in there and look at the financial statements and try to see evidence that there is a moat. And really that's where it turns out that they're able to, for long periods of time, it has to be sustainable, invest capital at a rate of return that's a lot higher than that capital cost, and that they have higher margins than their competitors. So we, of course, rate companies with moat ratings. There is an ETF out there that Van Eck has put out. We don't cover it, of course, because it'd be a conflict of interest, but they take our moat ratings and companies that we rate with moats, and they created a index that then the ETF tracks. And so they put out some research going back and looking at moats. So these are Morningstar moats, but they've looked at those two measures, and they've looked at wide moat companies. So those are companies where we believe they have a sustainable competitive advantage for 20 years or more, narrow moat, where we believe 10 years or more, and then no moat. And they looked at these two measures. So return on invested capital, and you can see that there is an actual impact here, that they are earning higher returns on the capital that they're investing in the business. And when we think about what happened, so it was a little different story when I started doing this back in 2020, because of course interest rates were so low. But think about these numbers right here. Well, even now, with interest rates going up, most companies would be able to beat their cost of capital that are wide and narrow moat. None, probably not at the end of the day. If you sort of look at how interest rates have gone up. So does that mean the company's going to go out of business? No, but it does mean that they might start investing in less projects as that return on invested capital, if that's below their cost of capital. Operating margin, you can see the same effect. So operating margin just looks at what does it cost? Well, what revenue do we get? And then what are our operating profits? So just running the business. We're going to leave all the other expenses outside of that in that case. So that's always going to be higher because we're not looking at all these other corporate expenses that they have and things like that. How much does it cost to produce a good or service that they sell and market that? And then we've got all these corporate costs on the bottom to pay for HR and finance and all these other departments. So you can see, once again, differences between that operating margin of wide moat companies, narrow moat companies, and no moat companies. And this is all research that Van Eck has put out that you can easily find on the internet. Net margin, that's when we're looking at top line and bottom line. That includes all the expenses. What's the profit? What's the revenue? And see, once again, that same impact right now. So what do you want to own? Of course, you want to own a company that's making 14%. So every dollar they sell of goods and services, they get to keep 14 cents rather than keeping 4.4 cents. Those are the companies that we want to own. So yes, that is the research on Morningstar's moats, which you can get from Van Eck. But hopefully that answers the question that we just had. All right, we're going to get into valuations now. And we're going to go through the discounted cash flow model. And I always start this thing out by saying that maybe this is something you do, maybe something it's not something you do. It is, of course, very difficult to do. It does take a lot of work. But I think it's important that people understand this because some of the terms that we will hear, whether we're going out and listening to a fund manager or anyone else talking about investments, some of the terms that you'll hear are related to how they value companies. And almost everybody everyone who's a fundamental analyst uses a discounted cash flow model. And the concept is very simple. As I said, and as that Bill Miller quote, more importantly, talked about, is that all that matters is what happens in the future. Why do we go out and buy any asset? We buy that asset for the cash flows that are generated in the future. If we go out there and buy an investment property, what do we care about? Well, we care about how much are we going to make from rent? How much are we going to make when we actually sell that thing down the line, if that's part of our plan? So we care about those cash flows generated by our investment in the future. We buy a bond. What do we care about? Well, we care if they pay us interest. We care if that issuer of the bond actually pays us back at the end. And what do we care about with companies? Well, we care about the cash they generate in the future, right? What are the earnings that company is going to generate? We don't really care what they did in the past. It's kind of the day that we bought it, or even if we own something, what's going to happen in the future? That's going to benefit us as investors. So the concept's pretty simple of a discounted cash flow. The value of that company is based on all of those cash flows that go out into the future. Now, the future, of course, is unknowable. And this is why this is more of an art than a science. We may use a spreadsheet. We may obviously, or we do use math, of course, to come up with all of this. But at the end of the day, you're trying to figure out what are all the different things that are going to happen in the future that are going to impact this company. So this is hard. It is not exact, even though it looks like it's exact because we're using math and we'll come up with a value of the company like $14.24. That seems very precise, but this is not precise. And that's why, we'll talk about this later, that's why we want that margin of safety built in for that lack of precision. All right, so here's how we do this. Very briefly and obviously high level. We want to estimate the revenue that is made in the future. We want to predict the profit margins, right? Because that's what we get to keep at the end. Those are those cash flows generated by the company. They have to pay all those expenses. And that, of course, will give us those cash flows out in the future. And this is, of course, difficult to do. There is a science side of it. So that's the art, where we're trying to think about all the different factors and how this company is going to do and the economy and everything else. There is some science to this. And the science is around a concept that really is the time value of money concept. And that is simply that a dollar today is worth more than a dollar in the future. And I think intuitively we all get this. If somebody came up to you and said, I will give you $50 now, or I'll give you $50 a year from now, what are you going to take? You're going to take the $50 now, because that $50 that you get immediately has a lot of utility. You can go spend it. You could put it in the bank and earn interest for a year. Lots of different things you could do with that $50. So cash in hand is always worth more than cash in the future. What does that mean? It means we need to discount that. So those future cash flows need to be discounted. And this discount rate is pretty important. And this is why valuations tend to change when interest rates go up, because there are lots of different ways we can discount that. What our analysts do is they discount it back by the weighted average cost of capital. That is how much it costs for the company to get capital. So that's equity capital that they can put out there. It is debt that they can go out there and borrow. So we're trying to estimate that weighted average cost of capital. We're using that for the discount rate. But all of that, of course, is impacted by interest rates. So if interest rates go up, well, that means, as many people have experienced lately with their mortgage, that means, of course, well, the cost of debt goes up. The cost of that money you borrowed to buy your house has gone up. Higher interest rates mean higher discount rates. Higher discount rates means we are discounting more. It makes those future cash flows worth less. So you'll hear that all the time from people talk about discount rates. They'll talk about the risk-free rate. They'll talk about the equity risk premium. But all they're talking about, all of those combined, is that, yeah, what are we going to discount back those future cash flows? And it's pretty simple. Like we saw, and this was an example that was given at our conference, that that this transaction on a McDonald's happened, I believe down in Wollongong, and that somebody sat there and decided to buy this McDonald's earning 3% a year, right? So at the end of the day, earning 3% a year doesn't look very good right now, which is the point the speaker was making, because I can go put my money in the bank and earn higher than that. So why would I risk my money by buying this McDonald's? And so the point is, and that's an example of, okay, well, the return that we're earning out into the future doesn't look as good because interest rates have gone up. So it's just an example of why we discount things by more. We demand higher returns on things if interest rates are up, because that alternative, risk-free alternative, is more. So we want to discount back all those cash flows to the present day. Now, a company is, of course, something that in theory can operate into perpetuity, right? There's no end to a company. So how do we estimate cash flows out until the end of time? Well, we don't. So what an analyst will do is they will take a window that they think that they have a reasonable chance of estimating cash flows, right? It's a little easier to try to figure out what a company is earning next year rather than 20 years from now. So they will take a window, generally 5 years, maybe 10 years, but they'll take that window, they'll do all their work to try to figure out the revenue and the profit margin and everything else. And then what they'll do is they'll calculate what they call a terminal value. And the terminal value is just saying, I can't accurately estimate what a company is going to earn in 20 years. So at a certain point, I need to stop and say, okay, we know the company is going to make some money afterwards. How do we estimate those values? And what they'll do a lot of the time is they'll just put a growth percentage on there that generally is equal to kind of what they think is going to happen in the economy. Might be a little different for different industries. And they'll say, okay, well, I think GDP growth is going to be 2.5%. I think the company can match that. So we, of course, will put that out as the terminal value. We'll estimate that back again. And what that's going to give us is a value. All right, so we're saying this company's earning $1 next year, $2 a year after that, $3 a year after that. We're discounting those back. We, of course, will come up with some sort of value for the company. And that's how analysts generally estimate, and it's an estimate, how much a company is worth. So I've got an example of this, and I'll kind of go through this on a high level, but yeah, these are some of the things that you look for. We're looking for revenue growth. How fast do we think they can grow revenue? What are the margins going to be? What is this weighted average cost of capital? What's that discount rate we're going to use? We need to look at debt and cash as well. I won't go through every line of this. This is obviously a very simplistic version, but this is really what you have to think about as an investor. Okay, what's going to impact those cash flows? What's an appropriate discount rate, and how might that change over time and impact the valuation of the company? And hopefully this allows you to understand when people start talking about these different concepts. All right, I'll pause for a second because I think we had a couple questions and a comment from Jane saying, thank you, moats float my boat, which I like. We should make t-shirts for that. But that's a good one. So Rod says, you may want to mention the impact of deflation on the normal perception of a future discount. Okay, so let's talk about inflation and deflation. And if I'm missing the mark of what you want me to talk about, Rod, just let me know. So obviously prices change, and we all know that. Right now, of course, prices are changing a lot higher than most of us want. So all of those, that needs to be built into the models that we have. Changes in prices, because it matters. Remember, talked about very simply, we produce as a company a certain amount of goods and services. So we'll do a simple example that, if I have a factory that builds cars, we'll use cars for example. If I have a factory that builds cars, well, that's great. I know how many cars I can produce in a year. Hopefully I can sell them, but that price matters. So we do want to include that price. Now, price changes are going to impact all sorts of different parts of the company, because it's not just the price they're selling stuff for, it's the price that the inputs cost, it's the price to pay their employees. So we do want to have, of course, estimates for inflation or potentially deflation. So deflation, of course, is when things cost less in the future. So we do want to include all of that. I will say that, generally during high inflation times, interest rates are higher because, of course, interest rates are raised to combat inflation, and that could have impacts on that discount. So hopefully that's what you wanted me to talk about, Rod. But anyway, let me know if it's not. Okay, so Rachel is saying, could you please elaborate on the margin of safety that was mentioned earlier? Yeah, very simple. Okay, so in this model right here, we've decided this company is worth $12.67 a share. As I said, that is very exact and it looks very precise. But we know that this involves estimating what's going to happen in the future. The future is unknowable. So even though this looks very precise, it is not precise. You wouldn't go out there and buy this share for $12.66 and say, that's great, I've got a discount. What we want to do is we want to build in that margin of safety. The margin of safety is, number one, to account for the imprecision in this model and the imprecision on trying to figure out how much a company is worth. It is not precise. It is guessing about future events when we don't know what's going to happen. It also builds in a buffer for risk. So the risk can be that, number one, the work that we did to estimate how much the company is worth is wrong. And number two, the risk that something happens. Risk that something happens could be a recession. The risk that something happens could be that interest rates go up significantly. The risk that something happens could be a global pandemic that shuts down business for 6 months. So we want to include a buffer in there, and that buffer protects us from all of those different factors that I talked about. So the buffer, at least as Morningstar thinks about it, the size of that buffer varies by companies. Some companies are, of course, riskier than other companies. So we want to build in a buffer there. So some companies are very small and they're maybe trying to create new products where a market hasn't been established yet. They don't have a lot of money and they don't have access to financing. All those things make it riskier. Some companies are very cyclical. So if we fall into a recession, it has a huge impact on them. Some companies are not cyclical. So that means that it doesn't really matter what happens. People are still going to go buy food. They're still going to go to Woolies. They're still going to go to Kohl's. So companies have inherently different risk. The riskier the company, and remember, we're using that margin of safety to protect us from future risk. The riskier that company, the bigger the margin of safety we want. So if you went out there and bought a huge company, if you went out there and bought a bank, you went out there and bought Westpac, has a very different risk profile than going out and buying some startup. So we want a bigger margin of safety for that startup. You can have a smaller margin of safety for a very well-established company in good financial shape. And so that's going to adjust that margin of safety. But that's just protecting us from risk. And that's why we want a margin of safety. Got a question. Is there an Excel spreadsheet available to play around with the DCF model? Yes. Email me, mark.lamonica1@morningstar.com. I will send that to you. So Nicola says, you mentioned some sectors have historically higher return on invested capital when you're talking about modes. Which sectors have historically had better returns? Yeah. So pretty simply, when you compare things like margins and return on invested capital, they will vary by industry. So the first thing you want to know is, okay, well, some industries naturally have higher returns. And those industries typically are industries that are very scalable, that are cash and asset light businesses. So it is easier, and we'll go back to Microsoft a long time ago. If you were a company like Microsoft, you have a bunch of people sitting in the room, and I'm obviously making this very simplistic. You have a bunch of people sitting in the room creating the old Windows suite, right? Now, whether they sell that software to 1 billion people or one person, you're going to need the same amount of people to develop it. So that company becomes very scalable. Non-scalable companies are companies that have a lot of assets. So if we go back to a traditional manufacturing business, we'll use the car business because I used that example before. Well, a factory can only build so many cars. So if I want to expand my production, what do I have to do? I have to go build this whole new factory and invest all this money in this new factory. So that is a very asset heavy company. So your return on the money that you invest, what do you do if you're Microsoft? How do you invest more money? Well, maybe you invest more money in marketing. Maybe you hire a couple other people that you can frankly get rid of if things don't work out. So that's a lot better of the business model. And so that is why you see different valuations for different businesses. You are never going to get the same valuation on a technology company as you are on a miner, for example, that has to invest a huge amount of money to create a new mine and then transport that good somewhere else. So we do just have to understand that when we're comparing companies, BHP can still be a great company if BHP has a higher margin, higher returns on invested capital than Rio and their other competitors. We can still sit there and say BHP is a great company, but we can't compare BHP to Microsoft because Microsoft's always going to earn higher returns. That's why we want to compare within opportunity sets, compare within industries. And if the valuation levels were the same, then we could just find whatever is the best company, but you're going to get different valuation levels. People are going to pay more for earnings from one of these universally acknowledged great companies in industries that have very high returns. So hopefully that answered your question. Okay, so Rod is saying, and it's a good point. So he's saying deflation would mean $50 now would buy less than $50 in the future. Yeah. So, what happens obviously when we are in a deflationary environment, and fortunately we haven't had one in a while, but Japan's a really good example. What did Japan do? Well, Japan has had almost zero interest rates for since the early 90s at this point. And so what that's going to do is, of course, it's going to lower that discount rate significantly. So I think people still want cash in hand because there's risks to those future cash flows, but you are going to discount them a lot less. They're going to be worth more. I think people would still want that $50 today, even if there's deflation, because remember, there's risk in those cash flows that are generated in the future. But it is a really good point. Do companies generally provide, and then I'll move on after this, do companies generally provide future revenues for the next number of years for public consumptions? It depends upon the company. Most companies will provide guidance. So they will provide guidance that is in a range generally. So they would come out there and say, hey, next year we think we can grow revenue to between X and Y. And that guidance, of course, does move share prices, particularly if that guidance changes. If all of a sudden they're increasing that guidance, everyone's really happy. They're lowering that guidance, everyone's really upset. But most of the sort of exact estimates, when you read in the paper that a company has reported earnings, those exact estimates come from analysts when they're like, oh, they beat expectations. So they do provide guidance. It's generally fairly limited. It's in a range. It won't go out too far into the future. But yeah, companies do provide their thoughts on what can happen or what they expect to happen in the future. So hopefully that answered your question. All right. So just want to quickly go through this InvoCare example. Once again, funeral home operator, they're gone. They were bought. But just want to show, if you're reading an analyst report or if you're reading the discussion of a company in some sort of financial media, how we kind of see these terms. So I just took quotes from an analyst report, and you can see these terms are starting to come out. So Angus, who covered InvoCare, we expect returns on invested capital average 13.1%. during the next 10 years compared with 11.5% in the last decade. So what is he saying? He's saying that this company is going to earn higher returns. That's a very good thing. That's his estimate of what's going to happen in the future, exceeding the company's 7.2% weighted average cost of capital. So, right, this is pretty good. You can go out there and let's just say borrow money for simplicity's sake. You go out and borrow money at 7.2% and earn a return of 13.1%. That's a good thing, right? So that's an example of what a wide economic moat can do. And that was the rating that Angus had on InvoCare. So just an example of some of the terms that we're using. Here we can see how he's talking about this model. So he estimates sales to grow at 9% over the next 5 years. CAGR, so that's just compounded annual growth rate, but we're looking at 9% over the next 5 years. He talks about why, right? They're going to raise prices. So that raises revenue. So sales and revenue are the same thing. More people die because, of course, if you are a funeral operator, that's your customers, right? You need people to die. And growing market shares, all right? When we start thinking about these different things that are going to impact this company, that's what he's saying. Population is getting older. That means more people are going to die. And he thinks it's going to accelerate. So he's looking at the different drivers. He's going through thinking about, okay, if I'm evaluating a funeral home operator, what matters? Well, how many people are going to die? Generally, there aren't huge differences in deaths year to year, but there can be demographic differences. So he's trying to factor that in his model. Then, of course, we look at margins. So EBIT, earnings before interest and taxes. You expect those margins to be 20%. Not that the company made it to 2025 by fiscal 2025 from lows of 12%. So that's good, right? Margins increasing are good, and he talks about why. So you can sort of see why these margins are going up. They invested all this money to transform the business. Well, that's great. There's a temporary investment. That's going to go away, and they are going to get more competitive prices for coffins, food, beverage, and transport, which I guess are the important things, right? You got to put the body somewhere. You got to move it around somewhere. You got to feed people at a funeral. So he's looking at some of those input costs and saying they can get more competitive environments. So just an example, once again, is we need to remember as investors, we're buying businesses. You're trying to think of those drivers that are actually going to impact the business, especially if you're putting together one of these models. And this is actually a model from InvoCare. As I said before, the average investor probably isn't going to do this, but the whole point of us going through this exercise is to start thinking about them as companies, thinking about the things that are important. How much are they going to grow sales in the future? How much of that are they going to keep? What's that margin? What are the things that are going to influence that margin? And then what is that discount rate? What are they going to earn if they try to grow that business? So on that capital that they invest. So yeah, just a couple points there. I want to go through relative valuation measures as well, because we hear these a lot. And it's important just to understand how we use these. Relative valuation measures are things like price to earnings, price to forward earnings, price to sales, all these P ratios you hear. P is obviously the big one. Now, it's important to remember that this is not a way that we value a share. But this is a way that we look at valuation. So there are two kind of different things. So when we say the price to earnings ratio is 15, if I just told you a company has a price to earnings ratio of 15, that fact in isolation does nothing for you. Is it cheap? Is it expensive? None of that information does not provide any information to you. The reason we call it a relative valuation measure is because we need to compare it to something else in order for it to have meaning. So if I told you that the company is trading at a PE of 15, and for the past 10 years, it was trading at a PE of 20, all of a sudden we can make an inference off of that. The company is cheaper than it was. Now, there could be lots of reasons for that. We need to understand those reasons. It could indicate that the company is going downhill, and that everyone thinks that it doesn't have a great future, so they're willing to pay less for those earnings. It could tell you the company is temporarily cheap because of something that spooked investors, or maybe the whole market went down. So that's why we call them relative valuation measures. We can also compare companies within an industry. We can say that, and remember, different industries are going to have different valuation measures. Don't compare a tech company to a miner. But we can sit there and say BHP's, and I'm making up a number here so everyone's clear, BHP has a price to earnings ratio of 10, and Fortescue has a price to earnings ratio of 20, and Rio has a price to earnings ratio of 20. So then we can say, compared to its industry peers, BHP is cheap. But once again, we need to understand why. What is the reason for that? If that reason makes a lot of sense, then maybe the company's cheap and it'll always stay cheap. If that reason doesn't make any sense, or we think that it is wrong, then that's an opportunity to maybe find an undervalued share. So for all these relative valuation measures, just remember, we don't want to look at them in isolation. They do not prevent or they do not allow us to just ignore everything about the company and the industry. We need to understand it, and we need to try to explain it. So an analyst could very well sit there and say, BHP is cheap because their earnings have temporarily fallen because there was a problem at some mine that they own, and they couldn't produce anything for a year, and the earnings have temporarily come down. And so in reality, what's going to happen is those earnings will go up as soon as they do whatever they need to that mine and start producing again. Those earnings will go up, and the market is underestimating the power of getting that mine back open. So that's really, we can use those as long as we have a narrative around them. Why is something cheaper? Why is it more expensive? Is that deserved? So companies that, because we've been talking about this, companies that have very high margins would typically trade for higher price to earnings, right? So if we take, and this is true, if we take BHP and we take Fortescue, and we just look at iron ore from BHP, well, BHP's iron ore, and frankly everyone else's, is higher quality than Fortescue. So Fortescue sells their iron ore for less because it's not great quality and you need more of it to make steel. So that's a very simple example where, okay, we're not going to value the two of them at the same way, in the same way, if we're expecting increased iron ore production. If both BHP and Fortescue were going to double their iron ore production, what's more valuable? Well, it's more valuable to BHP because they can sell it for more than Fortescue, right? So that's an example where those margins really matter. And so we're always going to expect companies with higher margins, for example, to sell at higher relative valuation measures. So that's why we need to know the company and understand that, because just increasing production a little bit at BHP will have a bigger effect, will make them more revenue, will make them more profit, assuming that it costs the same to mine it than it would at Fortescue. So we need to understand that those margins are really important. They're all going to play a role in how we think about this. And, you know, this is just the kind of classic example that I was looking at. We've got two companies here. So one is clearly, without knowing anything about them, one is clearly more expensive than the other, right? Company A is far more expensive. We're paying 9 times sales. We're paying 37 times earnings. Clearly a more expensive company. But we can't just look at this on a spreadsheet and say, okay, well, I'll buy the cheap one. People say buy cheap shares, I'll buy company B. So what are these two companies? Simple example, it's Microsoft, which I talked about a lot. Kroger is a food store. It's the Kohl's of parts of the US. Selling software is a lot more lucrative than it is to go out there and sell groceries. Groceries are typically low margin items, right? So that doesn't mean one of these is a good investment or one isn't. It just means that we have to be very careful about how we value the company. Turns out that, okay, why are people paying so much more for earnings? Well, the company's growing a lot faster. They're earning higher returns on what they're investing in the company. They are making more money or keeping more money off of everything they sell. So this is just an example of why we want to be careful when we're just using these relative valuation measures without context and without properly using them against the specific industry that they're in. Because I think that confuses a lot of investors, and frankly, it confused me when I first started trying to invest. All right, so Lisa has a question. Can the valuation method be applied to an ETF? It can. So it can be applied to an ETF in a couple different ways. So one way is that if you have an ETF that's tracking an index, we can look at relative valuation measures for that index. We can make statements like, oh, the ASX 200 is historically cheap. It is trading overall, when we roll all of that up, it is trading at a lower level than it has historically. There may be reasons for that, but at least we can make those statements. The other thing we can do is, of course, look at relative valuation measures in terms of an ETF that may say that it's doing something, right? So it could be a thematic ETF or a factor ETF that says it's buying value shares, for example. We can go sit there and say, oh, well, it doesn't look like they're actually value shares compared to what they're actually saying. So we can do that. It would be very, very difficult to apply a DCF to an ETF because you'd have to go in there and value every company in that ETF and then roll them up. But yes, you in theory could do that if you wanted to, Lisa. Okay, I'll put in my email address into the chat so that, because I had a couple questions on that. Put that in. Let me just see if there's anything else. All right, looks like we got everything. So anyway, thank you guys very much for joining. We do have 2 webinars next Thursday. So we'll do one at 1 p.m. I don't remember what they're on, but we'll do one at 1 p.m. and then we have one at 6 p.m., Emily? 6 p.m., the night shift. So yeah, hope to see you guys there, and thank you for joining.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.